Welcome to This Explainer. Okay, so we're diving into West Fraser's second quarter 2026 earnings report today. And honestly, it's a pretty incredible turnaround story. We're talking a masterclass in corporate resilience. You know how crazy the global landscape is right now? Economic storms, shifting trade policies, wild supply chains. But despite all that, West Fraser pulled off a massive financial rebound. So, if you want to understand exactly how a major player in the lumber industry steers the ship when the macroeconomic weather gets rough, you are definitely in the right place. We're going to break down the exact numbers, the strategy shifts, and the long-term industry outlook straight from their financial disclosures. $125 million. I mean, in the world of massive manufacturing operations, quarter-to-quarter stability is usually the ultimate goal, right? But here, we are looking at a jaw-dropping $125 million swing in adjusted EBITDA just between the first and second quarters of 2026. To put that into perspective for a second, this isn't just some minor course correction. This is a massive, massive financial pivot over the span of just 3 months. Back in Q1, West Fraser was stuck in a pretty severe trough. They took a $66 million loss in adjusted EBITDA. Ouch. But by the end of Q2, they had completely climbed out of that hole to post a $59 million profit. So that's your $125 million bridge right there. The real question, though, is how exactly does a company build a bridge that wide, that fast? Well, let's dive right into what actually drove this. First off, we've got to address the elephant in the room. That massive $114 million non-cash adjustment for previous period duties and tariffs back in Q1. That anomaly really heavily skewed their first quarter results downward, which meant the Q2 baseline was naturally going to look healthier just by, not repeating that massive hit. But hey, it wasn't all just accounting magic. Look at the operational wins. Realized price increases added $51 million to the bottom line, largely driven by higher lumber and European pricing. Sure, they faced some headwinds, notably higher freight and resin costs, but the overall bridge clearly shows a company getting its financial footing back. And this bounce back really highlights a somewhat ruthless, out with the old, in with the new operational strategy. West Fraser is aggressively optimizing their portfolio right now. They fully completed the indefinite curtailment of their high-level Alberta OSB mill, purposefully moving away from less efficient operations. But at the exact same time, they're ramping up their modernized Henderson, Texas sawmill. Output there literally more than doubled in the second quarter. They are laser-focused on shifting production strictly to their most modern, efficient, and cost-effective facilities. So, as you'd expect, these strategic shifts had a direct impact on their output. Overall, Canadian lumber production rose, with spruce pine fir, or SPF shipments, jumping an impressive 18%. A huge driver there was the restart of their Blue Ridge facility in Alberta, getting it back to normal operating rates. Meanwhile, Southern Yellow Pine, or SYP, was up 5%. And what you really want to take away from this is their sheer operational resilience. I mean, they managed to squeeze out that 5% increase in the U.S. South despite dealing with a horribly challenging transportation environment and a real reduction in transport labor availability. Let's actually ground all this financial data in reality for a second, because we're talking about a company that literally builds foundations. In Q2, even with that mill closure we just talked about, the North American engineered wood products segment generated a very solid $13 million in adjusted EBITDA. This sector remains an absolute core pillar of their business. They take raw timber and turn it into the structural panels like OSB that quite literally builds our housing infrastructure. Now, we do need to zoom out and look at the macroeconomic hurdles impacting the industry, specifically international trade tariffs. There are two main tariff actions at play here. First, you've got the Section 232 tariff from October 2025, which slaps a 10% rate on imported softwood lumber. Second, there are the newly announced Section 338 tariffs hitting in August 2026, imposing a massive 50% rate on select Canadian products. But, and this is crucial, the data shows West Fraser's exposure is actually pretty contained. They estimate these Section 338 tariffs will only hit about 3% of their plywood shipments and roughly 20% of their laminated veneer lumber or LVL shipments to the U.S. All the while, their softwood lumber, OSB, and a chunk of their MDF completely dodged the specific new measure. But hey, tariffs aren't the only macroeconomic headache they're dealing with. Look at this number. $13 million. Across all of West Fraser's divisions, they had to absorb a massive $13 million quarter-over-quarter spike just in resin and wax costs. In a single quarter, the cost to procure the essential chemicals and waxes needed to buy in their engineered wood products jumped that significantly. The real so what here is understanding exactly why that spike happened. Resin and wax costs are directly tied to global crude oil. It's actually fascinating when you think about it. Geopolitical conflicts in the Middle East that disrupt global oil markets eventually ripple all the way down to a wood panel manufacturing plant in North America. West Fraser's data shows that just a $10 per barrel increase in crude oil tacks on roughly $15 million to their annual costs. It is quite literally a textbook example of how global macro volatility hits a company's bottom line on a micro level. So how is leadership actually managing all these crosswinds? CEO Sean McLaren put it plainly, saying, "We continue to focus on maintaining a strong balance sheet and being disciplined in controlling costs to navigate the current environment." Now, I know that sounds like standard corporate speak, but it's actually their core survival strategy. By keeping an incredibly tight grip on their capital, like we saw with closing older mills and ramping up new ones, and keeping their balance sheet highly liquid, they're essentially building a financial fortress. They're preparing to weather the storm of tariffs, oil price spikes, and inflation until consumer demand finally recovers. And speaking of consumer demand, let's map out the housing market for a minute, since that's the ultimate driver of lumber sales. In the near term, yeah, it's undeniably tough. Weak consumer confidence, sticky inflation, and high mortgage rates are causing serious affordability issues. But if you look medium term, the U.S. has this ongoing housing supply deficit, and the median home age is sitting at 44 years old. Think about it. Those homes are going to need repair, remodeling, or replacement, right as a huge cohort of millennial buyers really enters the market. And long term, the growing adoption of mass timber and commercial and industrial construction opens up an entirely new avenue of demand. It's absolutely a story of short-term pain for long-term gain. Knowing that demographic wave is coming, how is West Fraser actually positioning for the rest of 2026? Well, they are targeting some massive volumes. We're talking 2.4 to 2.7 billion board feet for both SBF and SYP lumber. North American OSB is targeted at 5.9 to 6.3 billion square feet. Plus, and this is key, they are committing $300 to $350 million in capital expenditures, focusing heavily on getting their newly completed major capital projects fully operational. They are actively sizing their operations perfectly to be ready when that housing demand fully unlocks. Which really brings us to our final thought. We've seen exactly how West Fraser navigated a massive turnaround and ruthlessly optimized their mills. But when you look at the broader picture, with a 44-year-old U.S. housing stock just waiting for renovations and an entire generation eager to buy homes despite lingering inflation, it really begs the question, is the lumber market quietly building the foundation for its next supercycle? The macroeconomic headwinds are definitely fierce today, but the demographic fundamentals for tomorrow, they're pretty undeniable. Thanks so much for joining me for this explainer. I really hope this helped you better understand the fascinating dynamics driving this industry right now.